Let's see, if you invest well, maybe you can afford it someday. The monthly jobs report just came out. 156,000 jobs added in the month of December, a little bit worse than expected. The unemployment rate not changing much at 4.7%. Let's break it down with Matt Roddy from Rockland Trust. First of all, Matt, thanks for joining us as always. A little weaker job number than expected. Unemployment rate, I think, maybe ticked up slightly. What are your general thoughts on what we saw today?
It wasn't a whole lot of news in the number. I will tell you that the wages increasing at 2.9% is the most we've seen in quite a while. So that was good news. I think that's bullish. That gives the Federal Reserve a little bit more room to raise interest rates this year.
So for the average person at home, what does that mean when you see that the wages tick up a little bit?
Well, it means their paycheck's a little larger. 2.9% increase in average annual wages is pretty good for the average person. I did see that 19 states increased their minimum wage over the last couple months, so that's having an impact on that number, but it is good. I would also say that the number this month on the December jobs report was a little light, but November was revised up. So net, we're actually a little bit ahead.
Huh, interesting. And in terms of the wages, you know, because we've talked a lot about, like, when is inflation going to creep in? They've increased interest rates a little bit. They may do more. You see wages go up. Is inflation now going to be a factor in our economy?
Yeah, I think that's why the Federal Reserve raised in December. I also think that's why they think they're going to raise maybe 3 or 4 more times this year, is that they are seeing inflation start to tick up. 2.9% is well ahead of really where they want to be, but I think they can let it run a little bit more than they have in the past. Just because it has been low for so long, that giving a little bit of leeway is not a bad thing right here.
Before we get into some investment elements going into the new year, what is your sense of the overall economy heading into a Trump presidency?
I think it's in pretty good shape. I mean, unemployment's down to some low levels. Even the U6, which a lot of people talk about, which includes discouraged workers or part-time employed who want to be full-time, that's down to about 9.2%. The lows were 8%. We're pretty close. So from an overall, GDP growth was good in the fourth quarter. I think we're actually chugging along pretty well.
Okay, so people are at home, 401ks, or maybe they're living off their retirement, whatever they're doing. They saw their portfolios rise last year. It was a very good year in the market, near all-time highs. You turn the calendar into 2017. Do you change anything?
Well, everyone's a little different. I mean, I'm someone who's fairly aggressive, so I've got all my investments in equities. What I might be doing in that environment is changing a little bit from domestic equities to international, which didn't have as good of a year. However, if you're a retiree and you're living off 2, 3, 4, 5% of your portfolio and you're more balanced, I would highly recommend taking a little bit from those domestic equities, putting it in towards bonds, which didn't have a good year, and quite frankly, paying you the highest income they've paid you in several years. You're taking a portfolio that's returned 10, 12% in the equity market and putting in something that had no return last year, but now is going to pay you 50% higher than it did a year ago.
And you also have to think, as the stock market goes up, your percentage commitment to equities goes up because it
naturally.
So the quick question I have is, when are yields going to, or are they impacting, like, savings, CDs, and other, people that rely on a little bit of yield? Have we seen that trickle down? Even though it was a small interest rate hike, have we seen anything change in that field?
Not yet. I think you're going to see that soon, though. I think that this number, the 2-year bond yield starting to continue to rise based on today's number 2, you're going to start to see banks pay a little bit more, and that'll become a competitive dynamic to the stock market as people look over and see higher yields in bond markets, maybe higher CD rates. But I don't think you're going to look for a while yet, probably out to 2018, before you look at it and say, that's a nice, attractive bond yield. I'll take that.
Okay, so there's a quick takeaway to say goodbye. Stocks look to international, maybe to rebalance, and also the bond market might have a bit of a rebound after last year.
Yeah, and I'd look at some sectors that underperformed last year. Healthcare, consumer stocks really didn't do as well as industrials and energy. Rebalancing that will help a lot too.
All right, Matt, thank you very much. Matt Roddy from Rockland Trust.
Good to see you, Brian.